Hey guys, just a quick conversation. Today I want to mention something that came up just yesterday in Twitter world. Jace asked this question about maximum likelihood or least squares. If the error is not normally distributed, those methods may not converge to the same parameters. So which one should we choose to estimate a model? The maximum likelihood equation requires you to write a sophisticated objective function that is more difficult than, and then he was going to carry on with his sentence when I interrupted him. And I, just mentioned that they're probably going to be confluenced. So whatever's easiest to make the coding, choose one or the other. And so we got into this conversation about it. I thought it was really interesting because it's the first time that I've talked to a Citadel trader. So I am improving in the world, right? So basically, what he's talking about is when you have a tail, so you can tell from the JATS PT indicator that price was above the PT3, and so you know that you're out of range, right? The normal range with the JATS PT indicator, because this just gives you your average daily range. So if we're above the average daily range, we're in an extended mode. And how would you know whether to proceed on to your target? You can measure moves away from the range to give you a target to trade to, or whether that's going to, fade back in, flatten out, like a lot of the time it does when it gets outside of the range. How would you, what would you do? I guess I cut his sentence off, so I'm sorry about that. But it's an interesting question. To me, I mean, forget these green lines; those are the EMAs. This white red line is my linear regression that I use. I use the 4, and it's pretty binary. If it's inside the 4, you're going to find that reversion to the mean. Deceleration, you really want it to stay outside the 4, rising to go to the target. And you can see on my PT oscillator for that range, it's showing the range expansion. Right here, the slope is going up, but when we got outside our range, the slope started coming back down, showing you that deceleration. So that is your, the air coming out of the balloon. You're above your range, but the range is contracting. And so once it crossed under my 4, my linear regression, my least squares method, I would take my foot off the accelerator, absolutely. And here is the other absolute functions that I use using the EMA reference as my absolute function. Simply, because I'm not a rocket scientist, I just grab the easiest things to do. So you can go to the 200 EMA or whatever EMA combination you want, 1050, 150, 2050, 1, 200, whatever you want to construct, and make both levels hit a threshold. Sorry. Right here. So I've got the threshold over 100, So I can identify maximum likelihood of it being in an oversold range by being above my daily range and being above my threshold for these price to be away from the averages. And that's where when you return on your pullbacks, that's where you're going. You're pulling back to your averages. And that distance is something that we can trade. So we're going to be trading from trying to get that high peak back to your averages on a trade, or know when the price rolls back over and resumes the forward progress back out to your targets. And I I use the PT slope for the range contraction expansion at these levels to help me decide, and easily, not coding, I use bloodhound, and I can easily put my conditions using the thresholds with these absolute functions, the difference, to model these reversion to the means quite easily. And when he's saying this recent, here's another example. This recent, we didn't get the daily range expansion. We got a more price for the 200 EMA over 100 threshold, but the 50 threshold never made it to 100. It, never quite got that high. So you didn't have both absolute, like maximum likelihood conditions. You only had one of the two. And so it did end up rolling over instead of taking back off, but and that's because the range flattened out. You can see the progression of the price coming back into the averages, and we were inside the ones at this point yesterday, and it just flattened out like a pancake between the 200 and the 50 all day. And between the put call lines, that's where the put call lines were. I measured move off of them. Very interesting day yesterday altogether with put call ratios and just flatness going into a weekend. We're coming into this holiday weekend. So there's really no range expansion at all. We're flat on the averages, and the PT indicator also, you can tell we're inside the one. So I enjoyed that little thought exercise with him. It's very, very easy to construct this using Bloodhound, and I'll go over this with you guys. Anyone who wants to attend the training next week, just hop in to my Skype training class next week, and I'll show you how to put it together quickly with the Bloodhound solvers. It's really easy to do, and works really well. At least you know whether we want to do a RTM and get a good one, bringing us all the way back in. They can be very profitable. You can get, here's one that went back to the 200. A couple hundred points. And you can do the opposite too. So it's a good way to do RTM trades. Alright, very good. Maximum likelihood, linear regression. I was just showing, both conditions are going to be in confluence. So whatever's easiest for him. I just use a couple of simple things together. Very easy, very, very simple. You don't really have to get all that overly complex to find a good trading signal. Alright, thanks guys. We'll talk to you soon. Bye bye.